We're jumping straight into Rezolve AI today. Everyone is watching the price action, but the real story is the massive revenue acceleration and the profitability inflection point.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
It's great to be back. And honestly, we really have to set the table here because the noise in the AI space it's just deafening right now.
Oh, absolutely.
You open up your feed, and it is wall-to-wall companies promising the world, releasing these flashy demos.
They look great on social media.
They do. But then you look at the balance sheet, and they are just burning cash. I mean, burning cash like a bonfire in a hurricane.
It's the classic hype cycle. You know, everyone has a demo. Very few people have a business.
And a demo doesn't pay the bills.
Not in this market.
Right. And then you have Rezolve AI.
Yeah.
We're looking at a company that's seemingly done the impossible. They actually hit profitability in December 2025.
Which is huge.
It is. And before we get into the nuts and bolts of how, if you want to cut through all that hype and get these breakdowns every week, make sure you subscribe and hit that like button. We're here to simplify the complex data so you don't have to.
So let's talk about that profitability, because it's such a massive distinction. We're not talking about some adjusted EBITDA with a million asterisks.
Or community-adjusted numbers where they just ignore all their expenses.
Exactly. We are talking about a business model that actually sustains itself. But, you know, while profitability is the safety net, it keeps the floor under the stock. What really caught my eye is just the sheer scale of their ambition.
Oh, absolutely. I was looking at the guidance numbers last night, and I had to double-check I was reading them right.
The jump it's pretty wild.
They're projecting a jump from $40 million in revenue in 2025 to $350 million in 2026.
It's an absurd curve. It's almost vertical.
It is. That's an 8.75x increase in a single year. I mean, my first thought was that it had to be a typo in the filing.
You don't see that.
You don't see public companies forecasting nearly 900% growth. It feels,
Yeah.
well, it feels audacious.
It does sound unbelievable, doesn't it? But that's really the whole setup for today. You're looking at a relatively small player potentially outmaneuvering giants
By specializing.
by specializing in what they call commerce native intelligence. They're not trying to build a brain that can write poetry and code Python. They're building a brain that just sells stuff.
Okay, so let's unpack this revenue rocket, because that really is the headline. 40 million to 350 million. That's the kind of hockey stick graph that usually sets off alarm bells for me. It feels a little too good to be true.
Mm-hmm.
So where's the money coming from? Is this just hope, or is there a real pipeline here?
It's a fair skepticism. I mean, if I saw those numbers in a vacuum, I'd be skeptical too. But the data suggests it's coming from a huge shift in enterprise adoption.
Of their Brain Suite platform.
Exactly. And they're not just selling to one niche. They're getting picked up across retail, fashion, finance, even travel.
Travel is huge.
It is. But the key metric here, the thing that makes investors look at that 350 million and nod instead of laugh, is the annual recurring revenue, the ARR.
Okay, let's pause on that, because we hear AR thrown around all the time in the SaaS world. Why is that the gold standard here? Why not just look at total sales?
That's a great question. Think of it like this. If you run a car dealership, you sell a car one time. That's a sale. Great for today, but tomorrow you start at zero.
Right, you got to find the next buyer.
You have to hustle every single morning. It's unpredictable. In software, you want subscriptions. ARR measures that predictable recurring revenue that comes in every year from contracts.
So it's the difference between a one-night stand and a marriage.
That is one way to put it. And in this case, it's a marriage with a very expensive prenup. Rezolve is guiding for an exit run rate of $500 million in ARR by the end of 2026.
Wow.
That tells you this isn't a flash in the pan. These are sticky, long-term contracts. Major retailers are basically renting Rezolve's brain to run their stores.
500 million in recurring revenue? That's serious money. That puts you in a completely different weight class.
It moves you from promising startup to mid-cap player.
And we touched on it, but that profitability in December 2025, I feel like we just can't stress enough how rare that is for an AI infrastructure company right now.
It is the holy grail. I mean, just think about the landscape. You have companies burning hundreds of millions, billions, really.
Just to train the models.
Just to train models, hoping that eventually they can monetize them enough to cover the electric bill. Rezolve has flipped that script. They've achieved positive unit economics early.
Positive unit economics. So just to clarify for everyone listening, that basically means they make money on every sale, right?
That's it.
They're not just selling a dollar for 80 cents to grab market share.
Exactly. It proves the business model works now, not 5 years from now. It means they aren't dependent on constant capital injections just to keep the lights on.
Which brings us to their bank account. They just closed a financing round, didn't they?
They did. They are far from hurting for cash. They closed a $250 million oversubscribed financing round.
That's a fortress balance sheet going into 2026.
It really is.
Okay, so let's play that out. If I'm holding the stock, what does that $250 million in cash mean for me? Why should I care?
It means security. The biggest fear with these high-growth companies is dilution. You worry they'll burn through cash, announce a secondary offering, and just crush your shares.
Happens all the time.
All the time. With this cash pile, Rezolve has the runway to develop products, expand sales, and execute on that growth plan without going back to the market with a tin cup. They control their own destiny.
That is a luxury in this market. Okay, financials look solid, but I want to pivot to the how.
Yeah.
This is where I get a little stuck. Why are retailers choosing Rezolve? I mean, if I'm a huge brand, why not just plug ChatGPT into my store? Why do I need these guys?
And this is where it gets really fascinating. This is their moat. Rezolve uses a proprietary model they call brain power.
Brain power. I like the name. But what does it actually do differently?
It solves the hallucination problem.
The hallucination problem. That's when the AI just makes stuff up, right?
Correct. If you ask a generic model to summarize a poem and it gets a word wrong, it's fine. No big deal. But imagine you're a retailer. You ask a bot to sell a customer a jacket, and it invents a 50% off coupon that doesn't exist.
Oof, that's expensive.
Or it tells the customer the jacket is waterproof when it's actually dry clean only silk. You get sued, you get chargebacks, you lose money. It's a disaster.
Right. You need to be boringly accurate. You can't have a bot making up prices or product features. It's a compliance nightmare.
Precisely. Rezolve's model is deterministic.
Break that down. Deterministic.
It means it's non-hallucinatory. It's built specifically for commerce compliance. It only knows what's in the retailer's catalog, and it follows very strict rules.
So it's the difference between a creative writer and an accountant.
Perfect analogy. You want the creative writer for your marketing copy. You want the accountant handling the transaction. Rezolve is the accountant. No improv.
That makes a ton of sense for big risk-averse brands. They can't afford a PR disaster because their AI went rogue.
And there's a secondary effect here that investors love: switching costs. Once a retailer integrates this into their checkout, trains it on their inventory, sets up the rules, it is incredibly difficult to rip it out.
It's sticky.
Incredibly sticky. It creates a defensive moat. You're not just swapping a logo, you're changing the brain of your entire store. No CTO wants to take that risk.
I see. Once you're in, you're in.
Yeah.
Okay, so now the valuation. This is the part that makes my head spin a bit. Market cap is around $1.09 billion.
Right. Just over $1 billion?
But if they hit that $350 million in revenue, they're trading at roughly 3.1 times forward revenue.
Which is exceptionally low for this sector.
It seems incredibly cheap. I mean, high-growth SaaS companies usually trade at what? 8, 15 times revenue?
Easily. Sometimes 20 or 30 times in their high growth phases.
Yeah.
Trading at 3.1 times implies the market has not priced this new growth in yet.
So the market's skeptical.
The market is looking at that guidance and saying, show me.
So there's this disconnect. The company is saying, we're going to the moon, and the market's saying, we'll believe it when we see the earnings report.
Precisely. And that gap is where the opportunity lies, but also the risk. If the market believed that $350 million was a guarantee, the stock would probably triple the price. The discount is the risk premium.
Well, that is a perfect segue, because that sounds perfect, but let's break that down even further. What could go wrong?
Well, the biggest risk is simply execution. I mean, growing revenue 8.75x in a single year it's absurdly difficult.
It is a steep climb.
It's a vertical wall. Even with the best product, you have operational constraints. Can you hire salespeople fast enough? Can you onboard all those new clients without the support system breaking down?
That's a great point. If you land 50 new enterprise clients in a month, you need engineers. If you don't have the people, that revenue gets delayed.
Exactly. Or the system crashes. Or customer service wait times go to 4 hours. If they miss that $350 million target, even if they hit $300 million, which would still be amazing growth, the stock could get punished.
It's the price for perfection problem. The expectations are now set at miracle levels.
Yeah.
And you mentioned the Crown Peak deal. A lot of this growth hinges on that ramping up fast, right?
It does. Crown Peak is a massive channel partner for them. But partnerships take time, legal, integration, training. If that hits a snag or the sales cycles are slower than they thought, that revenue gets pushed out.
And then there are the giants in the room, the 800-pound gorillas.
Yeah.
OpenAI, AWS, Google Cloud, Azure.
They aren't just sitting around playing checkers, no. And that is the existential threat. What happens if OpenAI releases a retail module that's cheaper or better?
That's the nightmare scenario. A giant comes along and offers your tech for free as part of their cloud bundle.
It's a valid concern. The nuance here, though, goes back to that compliance-first architecture we talked about.
The specialist versus the generalist.
It's the difference between a Swiss Army knife and a scalpel. If you're doing brain surgery or processing millions in transactions, you want the scalpel. The giants are building Swiss Army knives.
You don't want a chatbot that can also write poetry, handling your payment gateway.
Exactly. But the risk remains. If the giants decide to build that scalpel, they have the resources. Rezolve has to run fast enough to capture the market before they really wake up to this niche.
And then there's just market sentiment. Volatility is the name of the game with these AI stocks.
It is. The market is now expecting perfection because of this 100% upside chatter. When expectations are that high, any slight miss, it's going to cause volatility. You have to have a strong stomach for a trade like this.
Okay, so bull case, growth, profit, cheap valuation, bear case, execution risk, competition, volatility. For the listener trying to figure this out now, what are we watching? What are the triggers for the next 30 to 90 days?
We are entering a critical window, February through April 2026. The first and most important catalyst is the Q4 earnings report.
That's coming up late Feb, early March.
Correct. This is the test. Investors need to see the ink on paper. They need to see that December profitability confirmed in the audited numbers.
And the guidance.
The guidance is everything. Will they reaffirm that $350 million target? If they come out and do a beat and raise, that would be explosive.
But if they guide down, even a little bit.
If they guide down, the thesis takes a hit. The market hates uncertainty in high growth names.
Okay, so earnings is number one. What's catalyst two?
I'm looking at their Investor Day and any updates on partnerships. We talked about Crown Peak, but keep an eye on the Google Cloud partnership.
So Google is a competitor, but also a partner. That's complicated.
It's the complexity of big tech. They're frenemies. If we hear news about deepening that integration, maybe a formal reseller agreement where Google sales reps are actually paid to sell Rezolve.
That would be a massive accelerator.
Huge. It turns a competitor into a distribution channel. That's the dream scenario.
And finally, catalyst three. Product announcements. We're hearing some chatter about Brain Suite v2.0.
Or specific modules, brain travel or brain fashion.
Why those specifically?
Think about the complexity. Fashion has sizes, colors, fits. Travel has dates, cancellations, connecting flights. If Rezolve launches a module that handles rebooking flights automatically via AI, that opens up a whole new market.
That would be incredibly valuable. I'd pay for that myself just to avoid calling an airline.
We all would.
So sentiment-wise, where are we? It feels like the analysts are getting on board.
They are. Sentiment is shifting from wait and see to bullish conviction. You're seeing price targets that imply significant upside. But again, analysts can be wrong. The market is waiting for that earnings print to validate all the enthusiasm.
Okay, let's bring it all home then. We've covered the tech, the money, the risks. What's the final thought for the person listening right now?
Well, if we synthesize all of this, the trade is essentially this. You are looking at a company trading at a discount 3.1 times revenue, but with the growth profile of a superstar.
So you're getting the growth on sale.
You're getting it on sale because of skepticism. Plus, you have that safety net of profitability, which limits the downside compared to a cash-burning company.
So it's a show-me stock with a trust-me price.
That's a great way to put it. Rezolve isn't going bankrupt. The question is just how fast they can grow.
The lowdown here seems pretty clear then. The key is whether they can execute on that $350 million promise. If they do, a multi-year re-rating seems likely.
And if they stumble, it's going to be a bumpy ride.
Exactly. Keep your eyes on the earnings print in February. That's the scorecard. If those numbers line up, this whole story gets very interesting very fast.
It certainly does, and it raises a really important question for you to think about. In a world where AI is becoming a commodity, is the real value in the general intelligence? Or is it in the specific, boring, safe application of it that actually sells the jacket? Rezolve is betting everything on boring.
A provocative thought to leave us with. Sometimes boring is very profitable. We'll be watching closely. See you next time on the Easy Money Show. And don't forget to subscribe.